This video explains the effective interest rate method. This is Ken Boyd with the Accounting Accidentally website, where you can find over 400 blog posts on the site and also links to over 350 of my YouTube videos on accounting. So I think this topic is poorly explained. It's an intermediate accounting topic, and what we're getting at is if you buy a bond for either more or less than face value, what does that do to income and expense? That's what we're getting at here. So let's say we buy a bond at a discount. A discount means that the buyer pays less than the par or face amount, which is the stated amount on the certificate. So in this case, the face amount is $500,000. The purpose of using this method is it's a more precise way to measure the income or expense on the premium or discount versus straight line. So if you, and this is the key phrase, if you buy at a discount, the carrying amount, which is in this column, increases every year to the face amount. So in this example, it increases from $377,107 to right around the face amount with rounding over the 10-year life. I have a little bit of a rounding issue there. Another thing you need to know is that yield to maturity is a term that means the total return on the bond, which is two things: the interest payments, which you see in column A, plus or minus a discount or a premium. We'll see more of that in a minute. So it's a 6% bond. 6% times $500,000 is $30,000. The interest payment will be $30,000 every year, and it doesn't change. We're going to say, though, that this bond was, quote, purchased to yield 10%, meaning that the discount was big enough that if you add the discount and the interest payments, you didn't just make 6%, you actually made 10%. So that is the interest income in column B. So in year zero, $30,000 interest doesn't change. We have an unamortized discount, $122,893. Carrying value I mentioned, if you add columns D and E with rounding, you're going to get $500,000. And what you'll notice is the discount amortization increases, the unamortized discount decreases down to zero with rounding, and the carrying amount once again increases to $500,000. So we multiply column E, the carrying amount, times 10% to get $37,710. The difference between A and B in year one is $77,10. That $77,10 reduces the unamortized discount from $122,893 down to $15,182. And finally, the discount amortization increases the carrying amount. So the same thing each year. Column E times 10% in year two, $38,481. The difference between A and B, $84,81. Lowers the unamortized discount, increases the carrying value until we get the carrying value up to $500,000. So that is the effective interest rate method when you buy a bond at a discount that creates more income. On the other hand, effective interest rate with a bond purchased at a premium, more than the face amount. You buy a bond at a premium, the carrying amount goes down to the face amount each year. So in this case, we're buying a $100,000 bond for $104,100 with amortization and some rounding. The carrying value decreases down to $100,000. And again, I've got a little bit of a rounding error. So 4.5% times $100,000 face amount, we get $4,500 a year. That doesn't change. In year one, we multiply column E, the carrying amount, $104,100 times 4%, we get $4,164. The difference between A and B is $336. That is the premium we're amortizing, which is an additional expense. You'll notice that the bond was purchased to yield 4%, which is less than the face amount. And the reason is because we paid more than $100,000, we are creating more expense. That's what premium amortization is. The unamortized premium is lowered to $37.64. The carrying amount is lowered to $103,764. So over time, again, year two, we multiply the new carrying amount, $103,764 times 4% to get $4,150. The difference between A and B is $349. we lower the unamortized premium amount, we lower the face amount, and we just keep going with that until we get down to $100,000. So the premium creates additional expense. And if I go back, the discount creates additional income. So that's how we handled the effective interest method for discount bonds, for premium bonds. Remember that you can go to Conference Room. The address is here at the top, which is a community I have for accountants with blogs, videos, chat, and other resources if you're an accountant. Thanks for watching, and we'll see you next time.